Part 1, Introduction. Today we look beyond the sweat, passion, and roaring crowds to examine the deepest undercurrent of the sports industry, the control of capital. The public discusses how fast a Ferrari is, or how great Rafael Nadal is as the king of clay. However, what you need to observe is whom the pipeline of money beneath that stadium floor is connected to. We often call global sports like Formula One or tennis unscripted dramas, but from a financial perspective, they are merely rigorously engineered cash flow generation machines. Recently, a war among global private equity firms has begun to seize the blueprints of these machines. There are two distinct types of capital in this market. First, there is American capital, which seeks to acquire players or teams within a league to increase their value. They follow the traditional ownership model, improving team performance and boosting popularity through media exposure like Netflix. Second, there are the European predators who seek to acquire the league itself, establishing the rules and collecting toll fees. They do not buy teams. They monopolize the stadiums where the teams play and the commercial rights surrounding them. If you were a real estate investor, would you buy a single apartment unit, remodel it, and sell it for a profit? Or would you acquire the rights to collect management fees and approve reconstruction for the entire apartment complex? If the former is the method of American capital like Arctos, the latter is the method CVC Capital Partners demonstrated in Formula One and is now attempting to replicate in tennis. We will confirm that the history of private equity in sports is summarized by the path CVC paved, and the American capital now racing along that very road. Formula One is a market CVC dominated for 10 years starting in 2006. Completing the most legendary deal in private equity history before exiting. Conversely, tennis is an early-stage market where CVC has just entered to awaken a sleeping giant. Reject the one-dimensional interpretation that money is simply flocking to sports. We will look at the cold mechanism of exactly how that money flows, through which contractual structures and into whose pockets. Part 2, the mechanics, the blueprint of Monopoly One. CVC's acquisition of F1, LBO, and a ball launched by debt. Let's turn the clock back to 2006. When CVC acquired the Formula One group, Delta Topco, the market viewed it as a simple sports investment. However, from a financial engineering perspective, this deal was a flawless LBO model worthy of a textbook. The core mechanism here is hijacking cash flow. When CVC acquired Formula One, the enterprise value was estimated at approximately $2 billion, but they used only about $1 billion of their own equity. The rest was debt. The astonishing part was that the entity responsible for paying the interest on this debt was not CVC, but the acquired company, the Formula One Group. They executed the following strategic plays. First, utilization of monopoly status. Formula One is a monopoly league with no competitors. CVC used this position to aggressively hike hosting fees charged to host countries and broadcasting rights fees charged to broadcasters. Second, minimization of costs. Conversely, reinvestment costs such as marketing or digital transformation were strictly controlled. Fans criticized Formula One for losing its competitiveness, but on the financial statements, they created a structure where profit margins were maximized. Third, exit strategy. After inflating the enterprise value through this aggressive cost-cutting, they sold it to the American media conglomerate Liberty Media in 2017 for approximately $8 billion. Fourth, the result. CVC recovered over $4.5 billion combining dividends and capital gains, leaving behind a legendary rate of return. This is the terror of league-level investment. Individual teams see their revenue fluctuate based on performance, but the league owner collects tolls regardless of who wins. CVC owned this cash-generating machine for 10 years, took everything there was to take, and left. 2. The shift. Why invest in teams now? So in 2024, why are PEs buying stakes in individual teams rather than leagues? Capital like Arctos and Redbird is flowing into teams like Alpine, Aston Martin, and Williams. The reason is that, structurally, the door to league investment has closed. The current owner of Formula One, Liberty Media, is a NASDAQ-listed company. It is practically impossible for a private equity firm to execute an LBO of a massive listed media group. Therefore, the flow of capital has shifted from league acquisition to securing team equity. The mechanism operating here is the transplantation of the American franchise model. First, scarcity value. Formula One is fixed at 10 teams, and new entry is extremely difficult. This creates scarcity value similar to US NFL or NBA franchises. Second, valuation gap. Thanks to effects like Netflix's Drive to Survive, Formula One's popularity has exploded, yet American capital judges that the value of individual teams is still undervalued compared to NFL teams. Example: in the case of Williams Racing, Doralton Capital acquired 100% equity to take over management rights. This is not a simple equity investment, but a typical turnaround strategy. Buying a broken company at a bargain, normalizing it, and selling it at a high price. 3. Tennis, CVC's project to create a second F1. Now let's turn our gaze to tennis. After seeing success with Formula One, CVC selected tennis as its next target. The reason lies in fragmentation. First, the pinnacle of inefficiency. Tennis is operated by as many as 7 different organizations, including the ATP for men, WTA for women, the ITF, and the 4 Grand Slams. Broadcasting rights are fragmented, making negotiations difficult for broadcasters and confusing fans on where to watch matches. Second, the aggregation play. CVC saw this chaos as an opportunity. If you bundle scattered rights into one, the value becomes much greater than the sum of the individual parts. This is what finance calls an arbitrage opportunity. Therefore, CVC approached with the following deal structure. First, the target. They attacked the weakest link first, the WTA, the Women's Professional Tour. Second, deal structure. They carved out only the commercial rights of the WTA, such as broadcasting and sponsorships, to establish a for-profit entity called WTA Ventures. CVC injected $150 million into this entity to take a 20% stake. Third, the endgame. CVC's true goal is to use the WTA equity as leverage to eventually achieve a commercial integration with the ATP, the men's tour. The blueprint CVC is drawing for a tennis version of F1 involves packaging men's and women's tournaments together to sell at a premium to big tech companies like Amazon or Apple. Part 3, the precedents. The formula for winners and the graveyard of losers. 1. The failure. Why did football star PK fail in tennis? We learn more from failures than from successes. Let's examine the acquisition of the Davis Cup by Cosmos, recorded as the most painful failure in the history of tennis investment. In 2018, Cosmos, an investment group founded by FC Barcelona legend Gerard Piqué, signed a mammoth contract with the International Tennis Federation, the ITF, promising to invest $3 billion over 25 years. Their vision was to transform the Davis Cup, a national team tournament with 100 years of tradition, into something akin to a tennis World Cup. However, this deal met a catastrophic end with an early contract termination in January 2023, just 5 years later. What on earth went wrong? From a financial perspective, this deal was structural chaos itself. Mistake 1. The trap of minimum guarantee. Cosmos signed a contract structured around a minimum guarantee, requiring them to pay huge dividends to the ITF every year regardless of whether they made a profit. In sports marketing, this is the most dangerous poison. When the tournament was canceled or scaled down due to the COVID-19 pandemic, these fixed costs dried up Cosmos's cash flow. It was a typical mismatch where revenue generation capability could not keep up with the cost structure. Mistake 2. The clash with tradition. Private equity pursues efficiency, but sports live on tradition. Cosmos abolished the home and away format and changed it to a short-term tournament held in a single location. While this may have been an efficient choice to reduce player travel distance, it castrated the patriotic marketing unique to national competitions in the fervor of home fans. The backlash from fans and players led to a drop in viewership ratings, which triggered a vicious cycle of declining sponsorship value. Ultimately, the Cosmos case left a cold lesson. Capital alone cannot defeat 100-year-old customs. The market is not reorganized simply by pouring money into it. An investment that fails to align the incentives of stakeholders is bound to fail. 2. The success. What did CVC do differently in F1? Conversely, CVC's investment in Formula One took the exact opposite path. How were they able to record a phenomenal return of 450%? The core lies in the separation of rights and thorough commercialization. First, separation of regulation and commerce. Formula One's governance structure is unique. The FIA acts as the regulator that sets the rules and officiates, but the commercial rights to sell broadcasting rights and make money are monopolized by the Formula One Group, Delta Topco. CVC did not touch the FIA. Instead, they seized the Formula One Group and focused thoroughly on the right to earn money. This is the decisive difference from Cosmos, which provoked backlash by tampering with the match format. CVC maintained the position, you play the game, we'll earn the money. Second, ruthless revenue optimization. After acquiring Formula One, CVC reduced free-to-air broadcasting rights and increased pay TV contracts. It was a disaster for fans, but for the fun, it was the surest way to maximize average revenue per user. Furthermore, by signing long-term contracts that increased the hosting fees required from host countries every year, they completed an annuity-like structure where cash flowed in consistently even during economic downturns. 3. Setting coordinates. The current position of tennis investment. So where is CVC's ongoing investment in tennis position? Taking Cosmos's failure as a lesson, CVC is taking a much more sophisticated approach in tennis. In terms of equity structure, they did not attempt a 100% acquisition as they did with F1. Instead, they acquired only a 20% stake in WTA Ventures. This is a highly calculated political move to convey the message, we are partners, not an occupying force, thereby soothing the opposition of the Players Association. In terms of risk hedging, they avoided the curse of fixed costs that Cosmos suffered by not taking on the risk of entire operational rights, but taking only equity linked to commercial performance. Ultimately, the precedents in this market give a clear message. To rule a league, do not try to change the rules. Hold the wallet. Cosmos failed by trying to change the rules, while CVC succeeded by holding the wallet. This is the level difference between amateur capital and professional private equity. Part 4, the incentives, the geopolitical capital war. 1. The American way. Remodeling F1 into a U.S. professional sport. We have previously confirmed that CVC paved the road to monopoly at the Formula One league level. Now it is American capital that is driving on that road. Recently, it is U.S. private equity firms like Arctos Partners, MSP Sports Capital, and Redbird Capital that are leading investments in Formula One teams. The incentive for them to buy F1 team equity is clear. They intend to target the valuation gap that arises when converting F1 from a European aristocratic sport into a U.S.-style entertainment business. First, the appeal of a closed league. The biggest reason U.S. capital prefers sports investment is that there is no relegation. Formula One is effectively a closed league with 10 fixed teams. This provides downside rigidity, guaranteeing that a team's value does not fall to zero based on performance. Second, the mediaization of IP. Otro Capital and Redbird, who invested in the Alpine F1 team, are not simple financial investors. They involved Hollywood stars like Ryan Reynolds in the deal. Why? Because they view the F1 team not as a racing team, but as a media content production company. As Netflix's Drive to Survive proved, if the narrative of the team and driver sells, sponsorship revenue explodes even if they finish last in the standings. This is the monetization of storytelling, which U.S. capital does best. Third, infrastructure value up. Arctos, which invested in the Aston Martin team, funded the construction of the team's new factory and wind tunnel. This is similar to real estate development. It involves a typical real estate play, remodeling outdated facilities into state-of-the-art ones to increase asset value, and then exiting at a higher price. Ultimately, the goal of U.S. capital is to make F1 teams like NFL or NBA franchises. The American franchise philosophy that while performance is volatile, brand value is eternal, is being transplanted into Formula One. 2. The Saudi disruption. the destructive innovator shaking the tennis court. On the other hand, a much more savage war is unfolding in the tennis market. It is a systemic war between Western private equity, CVC, and Middle Eastern oil money, the PIF. As analyzed earlier, CVC calls for the integration of men's and women's tours. This is Western capitalist logic based strictly on efficiency. Their calculation is to bundle scattered products to increase media value and maximize investment returns. They intend to earn money by improving the existing system. However, the Saudi Sovereign Wealth Fund, the PIF, is different. They are not desperate for a 1 or 2% return on investment. Their goal is soft power and global hegemony. The PIF does not intend to buy stakes in the existing tours. They want to design a new board entirely. The evidence is their proposal to integrate the Masters 1000 series while using massive prize money as bait. This is a carbon copy of the strategy used in golf, where they created LIV Golf to threaten the PGA Tour. The unspoken pressure is that if the existing establishment does not comply, they could poach players and create their own Super League. This is the true fear that the PIF commands. 3. The clash. Efficiency versus pride. This geopolitical confrontation is driving the tennis market into unpredictable chaos. CVC uses its 20% stake in the WTA as a weapon, persuading stakeholders to create a rational integrated league together. Meanwhile, the PIF seduces them by promising to build a paradise free of money worries. The biggest variable here is the 4 Grand Slams. As the traditional aristocrats of the tennis world, they dislike CVC, whom they view as merchants, and they also dislike the PIF, whom they see as nouveau riche. Therefore, they are seeking a third way, aiming to create their own premium tour. Ultimately, this is no longer a field of pure competition. It has become a bloodless battlefield where Western financial capital, Middle Eastern sovereign wealth funds, and traditional incumbents fight for their own survival and hegemony. While players swing their rackets, a capital game involving trillions is underway behind the scenes, deciding the fate of the league. Part 5. The Syndicate's Note. Look at the scoreboard outside the stadium. In this session, we confirm what the real engine moving the modern sports industry is through the sleeping giants of Formula One and tennis. Many fans lament that romance has disappeared as sports have become commercialized. However, this is not the loss of romance, but a massive shift called the financialization of sports assets. The structural truths we have confirmed are threefold. First, CVC is the architect who integrates the fragmented rights of a league to create a monopoly status, thereby realizing astronomical arbitrage profits. Second, American capital like Arctos is the player who enters this design board to transform individual teams into media entertainment companies, enhancing their value. Third, sovereign wealth funds like the Saudi PIF are the system disruptors who are willing to destroy existing rules to build their own empire. Now, when you watch sports, do not be surprised by a player's salary or transfer fee. Instead, look at the cap table of the capital moving behind the scenes. Identify who holds the broadcasting rights, who designed the sponsorship structure, and who turns the valve of this massive cash flow on and off. Ultimately, the winner will not be the player who ran the fastest on the court, but the capital that owns the grass of that court.